Welcome to another installment of Tax Stuff You Should Know, a podcast that's brought to you by the law firm of Eric Fox Schiff, where we discuss topics that we believe to be of interest to business owners, to high net worth individuals, and to others who just have an interest in following the tax laws and how they are applied. My name is Bob Pluth. I'm a tax partner here in sunny Chicago today, and I'm joined by my esteemed colleague once again, Gene Magidenko from Michigan. Gene, how are you today?
I'm doing very well, Bob. Not sunny here today, gloomy and overcast, but I'm sure over in Chicago, the sun is not going to last any longer than 24 hours.
Probably not. Probably not. One thing that our lawyers suggest that we say is the comments in this podcast are the views of Gene and I. They're not the views of the firm, and they're for informational and educational purposes only. They shouldn't be taken as legal or tax advice. Uh, so, with that out of the way, we've got an interesting case here that we'll talk about today, Gene. It's called CFM Insurance versus Commissioner, and it was decided earlier this year in August of 2025 by the tax court. Actually, it was a memorandum decision uh, uh, in connection with an opinion rendered by a single judge. It deals with actually a local Chicago-based company, uh, sort of the American dream. A couple of folks, Angelo and Romana, Caputo, come to the United States and start a modest grocery store, uh, fresh fruit, vegetables, Italian baked goods. They have some success, great success, and ultimately their business blossoms into a number of full service grocery stores. They've got their own branded products of Italian products. They've got a full service, you know, grocery, as I mentioned, as well as a food counter where folks could come in and actually have meals in their stores. And then ultimately, they transition the business to their son-in-law, Robertino, and their daughter, Antonella, who met as youngsters in the store, fell in love, and, just a wonderful story. What we want to focus on today, though, is sort of the insurance aspects of their business and a planning opportunity that they took advantage of. Um, the grocery operation, which is actually much bigger than that, it ended up, with an import-export business to deal with their Italian-based products. They had a real estate holding company. They had a construction company to help them, build out new stores, et cetera. And they had some, fairly sophisticated insurance needs for their business, including things like product recall, food contaminations, foodborne illness liabilities, things of that nature. Um, and their longstanding insurance broker, this is back in 2012, introduces them to a company that purports to offer um, a solution to their insurance problems by setting up a captive insurance company, which the outside third party would oversee for the benefit of the taxpayers in this case. The benefits of a captive insurance company at the time were that, if they were to just set up reserves for potential losses over and above insurance, those reserves would be bookkeeping entries. They wouldn't involve and result in immediate tax deductions. If premiums are paid to an affiliated insurance company, a captive company, captive in this sense means that the husband and wife owned, each 50% of the shares, then the payment of those premiums by the the grocery end of the business would be deductible when made. And at the time, there was a special rule for micro cap insurance companies that did not collect premiums in excess of $1.2 million. That has since been raised at $2.2 million. But in any event, if you stayed under the $1.2 million cap, you, as the insurance company, did not pay tax on the premiums as they were received. So it was an attractive option that was implemented actually in the fall of 2012, where CFM Insurance was set up as a captive under the laws of the state of Utah. They used Utah because of relatively low capital requirements and just a general notion that there was a favorable regulatory environment. So we've got the taxpayers each owning 50% of the stock. Robertino served as president, and they had this outside consultant that was contracted to actually operate the company. So the company itself didn't have full-time day-to-day employees. And throughout this process, they were advised by their independent CPA firm as to the tax consequences. Um, so during the years in question, which are 2012 through 2015, they actually made premium payments of just a tad under the 1.2 million for the micro cap exemption at the time. And in 2016, the taxpayers amended their returns for 2012 to take into account a capital loss, or excuse me, a net operating loss carryback. Filed an amended return, got a nice refund, a little under $500,000. But shortly thereafter, the commissioner of the Internal Revenue came knocking with an audit and wanted to take a look at what generated this refund. And Gene, how many times have we seen this where the major driver for a nasty audit is generated by a claim for tax refund?
It comes up with some frequency. It's definitely flagging the attention of the IRS more than an originally filed return in certain circumstances, especially, if there's a material refund of tax being asked for on that amended return. Obviously, if the amended return shows you owe more tax, I don't know if the IRS would necessarily complain about that, but I think here there were probably some flags that went up.
Yeah. So when you're asking the government to send you a $500,000 check, you can assume that somebody's paying attention and may question the bona fides of that at some point. Um, Sadly, in the interim, the IRS actually flagged this uh, planning opportunity, these micro caps, as part of their quote unquote dirty dozen um, uh, tax planning ideas that folks should avoid using. Uh, the service's view is having nothing to do necessarily with the facts of this case, was that promoters came along with prepackaged deals, say, hey, all you got to do is sign these documents, and all of a sudden you're an insurance company. Um, and if the substance doesn't sort of line up with the form, as we'll see, there can be tax problems. So it turns out that this is really a cautionary tale, having much less to do. We don't want to get into the weeds on what's an insurance company and all the actuarial computations and whatnot, but it's more along the lines of you're doing tax planning, you're creating an entity. The entity is a specialized entity, ostensibly to be an insurance company. And if you expect the IRS or any taxing authority to respect it, it really needs to function like an insurance company.
Yeah, I think that's right, and that's where a lot of these microcap cases fall short, where, even if the structure at first blush looks good, maybe it's set up, in more or less an appropriate way, the follow-through may be lacking in a lot of situations, and, that creates a pretty big opening for the IRS to then go after that arrangement and try to recast it as they ended up doing in this case as well.
It's interesting in a lot of those cases, the taxpayers sometimes stub their toe on technical issues about what insurance means. Is there appropriate pooling of risk and distribution of risk? Uh, Insurance being a game, if you will, that relies on the law of large numbers. The idea being that if you pull together enough diverse risks into a single pool over time, you're more likely to be able to anticipate when those losses occur, and as a result, calibrate your premiums, make a reasonable profit, not go out of business, but have it all sort of hang together. This case is particularly noteworthy because the IRS's experts that they called in connection with the tax court trial really didn't um, give testimony that supported the IRS's technical claims about this shouldn't be an insurance company because of the various failures to have sufficient risk and distributional risk and pooling, et cetera. But rather, in many respects, the testimony was supportive of the taxpayers in that regard. So the tax court judge, sort of at the end of the day, said, "Look, I, we're we're not necessarily hung up on the technical record here. I got to take the record as I find it." But the question is, and that he delved into is, does this thing really operate like an insurance company? Certainly, it meets the formal requirements. It was registered, in the state of Utah, et cetera. But does it really look and act like an insurance company? And for those purposes, the court looked, at a couple of key things. Um, were the premiums reasonable, or were they just sort of made up numbers that didn't necessarily correspond with the risks? Were the policies sort of bona fide? Did they say what you would expect an insurance policy would say? Were they issued timely? Were the premiums paid in a timely way? Those sorts of things. And long story short, that's where the taxpayers fell down in this particular case. Not to pile on, but just to pull a couple of facts out. Um, the court found, for example, that for 3 of the 4 years in question, uh, virtually only one of the policies, arguably, was sort of issued in a timely way, and that one was issued timely if you believe that having 5 months left in the policy year was timely. Um, Premiums were paid more often than not either right at or near year end rather than upfront. I don't know, Gene, if you think about your experience with insurance companies, if you don't pay the premium, usually kind of ahead of when the policy period starts, you get a termination notice. Uh,
Exactly. They want the money up front, no questions asked, no excuses.
Thinking about sort of the technical nature of it, and the tax court trying to give the taxpayers the benefit of the doubt, they even delved into state law to say that, usually a binder is good for 150 days, but it's not good for, half a year or 11 and a half months. And so the court had problems with that. It also had problems with some of the policy terms, uh, things like an insurance premium against losing a key supplier, for example, uh, which is a fair concern, right? But the policy in question never defined what a key supplier was. Another policy to deal with the loss of a key employee. and having to go out and to replace that key employee. Fair enough, but again, no definition. So no idea of what a key employee might be. Just to take a bit of a detour, going back to the Dirty Dozen list, the services concern was that many times with captives, the risks that purportedly were being insured were fairly esoteric, like risk of getting hit by a meteor and having your facility wiped out, risk of invasion by aliens. Although, based on current news, maybe that's more of a risk than we thought. Um, that wasn't really the issue here. These were real risks, and folks preparing food and serving it to the public, or having product created and selling it retail for people to make in their homes. If something goes wrong, you could have a real problem. It was really all in the follow through. Um, the court also didn't like the notion that the insurance company really had no employees. Everything was offloaded to a independent third party. Um, Sadly, the taxpayer had sort of forgotten that he was president of the insurance company, went under oath, which was an unfortunate lapse. But the court, bottom line, got to the notion that this just isn't a bona fide insurance company, and so you fail for those grounds, alone. Um, Gene, I don't know. In planning, we can think of many circumstances where the follow through is key. Uh, this just being an illustration of one of them.
Agreed. Yeah, I mean, you can set up, what is on its face a great plan, something that works. And I think in the microcap space, obviously, this arrangement was entered into before, the IRS really started, very publicly devoting attention to this issue. But, it's certainly not helpful when you don't follow the formalities, and that's where you can get into some serious issues where, and this isn't just in tax, but in the corporate space as well, with piercing the veil, where you don't follow the formalities, you increase the risk of that happening. And again, a great structure isn't the end all be all, of planning. You need to set it up, and you need to make sure that you follow the structure to a T. And the less you hew closely to that, the greater the likelihood that the IRS will come in and try to recast that.
Fair enough. And in this case, one of the findings of the court was that the third party that was supposedly running the insurance company for a couple of years into this process didn't even have a claims department or any licensed claims adjusters, on staff. The insurance company itself, the captive, had no employees, so it became very difficult to try to argue that form and substance really lined up in this case.
Well, and
Uh,
I think that one of the other issues, which was a significant one, was the insurance company didn't require claims before paying out benefits. So in certain cases, they proactively paid out, for losses that were suffered by the business without even a formal claim on record. Just a lot of these kind of small hiccups taken together, I think, serve to indicate this is not a true insurance company. I mean, a real insurance company wouldn't operate in this type of a way, and I think that was what ultimately doomed the taxpayers in this case.
completely agree. Just with the limited experience, that we've all had with homeowners insurance, et cetera, you've got to state a claim. You've got to make your case. Sometimes there's a little healthy negotiation over whether or not you've got a good claim or not. Uh, but all of that was lacking, apparently in this case. Now, what sort of added insult to injury is the commissioner comes along and basically says, not only are the losses that flowed through from the payment of these, relatively large premiums disallowed, but you made a payment to an entity that you set up. That entity, we don't think meets the micro cap exclusion for premiums under $1.2 million. It had income on receipt. And the taxpayers, you could imagine, must have thought, oh my gosh, you're having it both ways, IRS. You're denying the deduction, but you're saying that our new company has got to pay tax on that income. And the commissioner said, yeah, that's exactly what I'm saying. So one thing that was sort of interesting about that is the court took notice of the following requirements, and basically said, and this is fairly black letter law, to recharacterize the transaction. That is, for the taxpayers to say that wasn't really income in the hands of our new insurance company. The taxpayers had to show two things. One, that the substance of the transaction didn't match its form. And two, that the form of the transaction wasn't chosen for purposes of obtaining a tax benefit that was inconsistent with, what the taxpayer, was seeking, even though disregarding the form. And it's basically an impossible test to meet by the taxpayers, and putting them in a position of having to argue in the alternative. Gee, Judge, if this was all bona fide, but if you don't agree, then it wasn't bona fide, and you should disregard the form that we've chosen for ourselves, which is high stakes tax planning and a very unfortunate result.
And I think in our experience, it's a very difficult argument for a taxpayer to make to disavow the form of their own transaction. The IRS certainly has a lot more free rein to assail the form of a transaction, trying to argue that the substance was different. If you're the taxpayer, in almost all cases, you're going to be held to the form of your transaction. It's very difficult to get out of that.
Understood and completely agreed. Now, the only silver lining here was perhaps in the penalty mitigation. Gene, if you could, you've got some thoughts about that. The commissioner came along and also assessed a 20% penalty, accuracy-related penalty in this case. How did that turn out?
I think that turned out a little better for the taxpayers than the substance of the case on the microcap issues themselves. I think what largely saved them was they were not sophisticated tax practitioners. Their job was running their businesses. They were business persons, and that was what they devoted their time to. And in this case, helpfully, they didn't just take the word of the advisors who helped them set up the microcap. They actually reached out to their tax advisors as well for advice, and were guided in that respect, which, did help them here because they could demonstrate the kind of the three major factors you need to have a good, penalty mitigation argument on the basis of the reliance on professional tax advice. So first, was their advisor a competent tax professional? In this case, yes. There was no question that their advisor was a competent tax professional. Did the taxpayers provide necessary and accurate information to the advisor? Again, they provided all the information that they had to the advisor. They didn't, hide the ball or anything else. And finally, did they actually rely in good faith on the advisor's judgment and advice? And that too occurred here. And on the basis of these, kind of three factors, they're called kind of based on the neonatology associates case out of the tax court from about 25 years ago. But essentially, the tax court looked through these factors and identified, yes, they were present here. And even though the taxpayers couldn't avoid having to pay additional tax or interest on any additional tax that would have been owed, at a minimum, they didn't also have to pay penalties on top of that.
Yeah, that was the one area of hope in this case for the taxpayer.
So I
So
guess there's a little bit of a, self-serving aspect there, Bob, right? Call your friendly neighborhood tax lawyer if, you wanna, you wanna undertake a transaction.
that's really good advice for penalty mitigation purposes. And in fairness, again, as we said at the outset here, uh, the the law in this area developed substantially after this particular structure was put in place, and maybe in ways that were foreseeable, maybe in some that were not. But boy, by the time you hit the dirty dozen list, it's not a good day for purposes of your planning. Um, any final thoughts, Gene, before we leave this one sit?
No, I mean, I think it's just an important cautionary tale. First and foremost on, kind of the follow through aspects of if you, set up a plan for, whatever reason, it's always best to follow through on whatever you set up as opposed to neglecting some of the formalities. I think, another lesson from this case is, to perhaps have some sensitivity to a situation where, maybe you're promised certain benefits and those benefits might just seem a little too good to be true. It's helpful to have a healthy sense of skepticism about that. Because even if you have people saying and swearing up and down that this is legitimate, that's, frankly, how we get a lot of these cases is at the outset, the planning, seemed good, but, it got unraveled over time, and it can take years, if not decades, to unravel some of these, issues. So, as you mentioned at the outset, when, the taxpayers here got into this arrangement, they didn't necessarily have any reason to believe their tax advisors didn't necessarily have much in the way of adverse tax authority, perhaps, to serve as a red flag, but ultimately, there would still have been perhaps some concern about, well, is this really legitimate? I mean, doesn't this seem maybe a little too good to be true? And, in some cases, there's a bit of a judgment call to be made that, well, something just doesn't quite sit right here. And, that doesn't always mean it doesn't work, but, at least to listen to that gut feeling and explore it perhaps a bit further.
Yeah, no question about it. The other, this took them into areas that for which the average business person would be unfamiliar. In terms of, okay, we're going to now make you an insurance company executive, and that's tough. That can be a bit of a stretch, and so it's incumbent on the taxpayers to um, ask questions, to understand the legal documentation, and the requirements personally of setting up an entity that is uh, arguably so much different than their normal day-to-day business activities. So, with that, I think we're done. I appreciate your insights again, Gene. And for those of you listening, feel free to reach out to us. You can email us at taxstuff, TAXSTUFF, at afslaw.com with any ideas or requests that you might have about topics that you'd like us to cover in the future. Until then, we'll see you next time.